Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. First up, we begin in Asia. As the Israel-Iran conflict escalates, China finds itself in a difficult position, caught between safeguarding its citizens in the region, maintaining diplomatic neutrality, and, most concerningly from Beijing's perspective, shielding its economy from a potential energy shock. While Beijing has publicly condemned Israeli strikes and activated consular emergency mechanisms to evacuate its nationals from both Iran and Israel, the deeper concern lies beneath the headlines: how a disruption in Iranian oil exports could ripple through China's energy-dependent economy. Beijing has grown heavily reliant on the discounted Iranian crude, which now accounts for over 90% of Iran's oil exports. Some may be wondering, I thought Iranian oil was sanctioned. Well, it was for most of the world, except, evidently, China. With international sanctions limiting Tehran's access to global markets, most of its 1.7 million barrels per day of crude are sold at a discount to Chinese so-called teapot refineries in Shandong province, northern China. These small privately owned operations have thrived by securing cheap feedstock that larger state-owned refineries have avoided. The economics of this relationship are significant. Iranian crude currently sells at around $2 per barrel discount to comparable grades like Oman Export Blend. Though the gap has narrowed from an average of $11 in 2023, it remains an essential cushion for Chinese refiners trying to preserve margins amid a slowing domestic economy. The arrangement also limits Iran's financial autonomy, as payments are often made in renminbi and recycled into Chinese goods, creating what one Iranian official called a colonial trap. Thus, this would have the double hit of hurting Chinese energy imports, hurting local industry, and hurting manufacturers that are trading with Iran who are using their RMB. Indeed, this fragile energy symbiosis may be heading toward a reckoning. If Israel targets Tehran's main oil export hub in a bid to disrupt Iranian revenue streams or catalyze regime change, the blow to China would be swift and severe. Not only would Chinese refiners lose access to bargain oil, but the global market could also see a supply shock with ripple effects across Asia and beyond. A major disruption would leave China scrambling to cover the shortfall with more expensive alternatives, just as global prices rise amid conflict. China has tried to insulate itself somewhat. It has been stockpiling crude oil aggressively, importing more than it refines to build a strategic buffer. This so-called war chest may offer temporary breathing room if Middle Eastern flows are interrupted. Still, strategic reserves are still not a long-term substitute for consistent supply. Some see an opportunity in this crisis. Russian analysts have argued that heightened Middle East tensions could accelerate the Power of Siberia 2 pipeline deal, offering China a stable overland gas supply from the north. But oil and gas are not fully interchangeable, and pipeline projects take time. Indeed, it would be over a decade before they could get the gases flowing. The Kremlin's eagerness to seal the deal may reflect Russia's need for economic lifelines itself, rather than China's strategic pivot. In the short term, the economic pain for Beijing could be acute. Refiners may be forced to buy pricier barrels on the open market, pushing up costs for fuel and manufacturing sectors already under pressure, with vanishing and, in some cases, completely erased margins. At the same time, a destabilized Iran means a weakened ally and fewer options for energy diversification, reinforcing China's vulnerability in a volatile geopolitical climate. For now, Beijing can only urge calm, protect its nationals, embrace for the economic consequences of a conflict it cannot control, but it can also not ignore. Next up, we move to the United States. Global financial markets are reeling from this renewed geopolitical tension in the Middle East, compounded by US President Donald Trump's posture towards Iran and a fresh wave of weak US economic data. As Israel continues its offensive against Iran and Trump calls for Tehran's unconditional surrender, investors are growing increasingly anxious over the potential for broader conflict and US involvement. Markets reacted swiftly and decisively. The S&P 500 dropped nearly 1% in trading yesterday, led lower by energy-sensitive and industrial stocks, while U.S. Treasuries rallied on a flight to safety. West Texas Intermediate crude surged to $75 per barrel, its highest since January, and the crude volatility index soared to a 3-year high. Meanwhile, the US dollar posted its sharpest one-day gain in a month, reflecting risk aversion and capital seeking safe haven assets. Oil traders fear that escalating conflict could lead to direct US military engagement and disruption of global energy supply chains. Quote, "The oil shock is real," end quote, said Kenny Polcari of Slate Stone Wealth, adding, quote, "Markets are now pricing in the possibility that this won't be a short-lived flare-up that changes the entire outlook for inflation, interest rates, and risk assets." End quote. At the same time, economic signals from the US are flashing warning signs. Retail sales fell for the second consecutive month in May, down 0.9%, the steepest drop in 2025. Industrial production declined again, and home buyer sentiment fell to its lowest since 2022, lowest level since late 2022. The consumer, long the engine of US economic resilience, is now showing signs of fatigue amid rising costs, elevated rates, and geopolitical uncertainty. Many analysts cite Trump's tariffs as one of the main reasons for the contraction, which have seen renewed legal challenges. A group of toy manufacturers, have asked the US Supreme Court to review Trump's use of the International Emergency Economic Powers Act to impose sweeping tariffs, arguing the measures are legally dubious and economically harmful. Quote, "The risk now is that geopolitics compounds already softening macroeconomic fundamentals," end quote, said Brett Kenwell, strategist at eToro, adding, quote, "If oil spikes and consumer sentiment drops further, the Fed will face an even more complex environment to manage." End quote. With the Federal Reserve meeting this week, markets are pricing in nearly 2 rate cuts before year-end, with the first expected by October. While the Fed is likely to hold rates steady in June and July, investors will be watching closely for any shifts in the central bank's tone, especially if geopolitical risks translate into higher energy prices and deteriorating economic conditions. It is still not clear whether this will be a short or a prolonged war in the Middle East, but if it is prolonged, this combined with renewed volatility in commodity markets and faltering US demand could derail the Fed's disinflation path. If oil prices remain elevated or spike further, central bankers may be forced to delay easing, even as growth slows. The combined threat of geopolitical instability, weaker consumption, soft manufacturing, and tariff uncertainty is now casting a long shadow over the US and global economic outlook. Investors will be bracing for a turbulent second half to 2025. We'll be covering all these developments as they happen every day. If you want to come along for the ride, make sure you're subscribed to Market Update, and if you're getting some value from today's episode, don't forget to hit the like button. And finally for today, Chancellor of the UK, Rachel Reeves, is set to unveil a sweeping £725 billion, almost $1 trillion, decade-long infrastructure program aimed at repairing and modernising the UK's ageing transport network, beginning with a £1 billion structures fund to mend deteriorating bridges, tunnels and flyovers. Multiple UK-based media outlets report that Reeves will pre-commit part of the capital budget ahead of the next spending review in 2027 in a move to provide long-term predictability and attract institutional investment. The initiative echoes similar plans under the previous Conservative government, but Labour hopes to accelerate high-impact projects to score political dividends ahead of the general election due by 2029. At the centre of the new plan is a £590 million cash injection into the long-delayed Lower Thames Crossing, a 14-mile road and tunnel project designed to ease congestion on the M25 at Danford and improve freight connections to channel ports. Ministers have described it as, quote, "the most significant road-building project in a generation," end quote. However, the funding still falls short of the £1.8 billion needed to launch the scheme under private finance, with more public money expected in stages. Reeves is positioning the infrastructure agenda as a turning point, to use her words, for Britain's physical assets, promising thousands of new jobs and better connectivity. The pipeline of projects ranging from roads and rail to nuclear energy and housing targets traditional Labour strongholds in the Midlands, North and Wales, but the party is seeking to fend off growing support for Reform UK. Still, concerns remain. Noble Francis of the Construction Products Association warned that despite bold announcements, actual annual funding for roads is set to fall by 17% over this parliament. Critics argue that reliance on private finance could also increase long-term costs for taxpayers. Meanwhile, the government promises to link procurement contracts with benefits to British workers and skills development, part of a push to tie infrastructure investment more directly to economic growth. With debt servicing costs elevated, opposition parties have questioned the wisdom of increased borrowing. Conservative Shadow Chancellor Mel Stride criticised Reeves for tax hikes and fiscal loosening, arguing it risks undermining long-term economic stability. The success of Reeves' infrastructure vision may ultimately depend on whether it delivers tangible progress before voters return to the polls. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you for another update tomorrow.